Hey guys, welcome back to another video, and today I'm here to talk about one stock in particular that I think is a really good investment right now. I think it could change your life, honestly, if you get into this stock right now. This is a very cheap stock for what it is. It's also a perfect time to buy this stock considering what's going on with the feds, with the funds rate, with the economy. I think that getting into this stock right now could, change the trajectory of your financial future. So if you do enjoy this video, be sure to smash the like button. Also subscribe to the channel. As of recording this, we're at 289 subscribers, almost 300. I appreciate you guys so much for subscribing. Let's get into it. So you can see the portfolio, very good day today. That's to thank NVIDIA, or not NVIDIA, my apologies, AMD. We don't have any NVIDIA. AMD, very great stock. I'm really glad I got into it, but that's not what we're talking about today. The stock we're talking about today, in case you haven't realized yet, is Realty Income, ticker symbol O. So what this company is they're a real estate company. They buy a lot of real estate, but they also are very diversified. And that's what I really like about this company is that they own a lot of commercial real estate. They own a lot of, single family, multi-unit complexes. They have a very nice portfolio, to say the least. And this stock's very cheap right now. If we look at the past 5 years, Realty Income has been a lot more expensive. They're down only a percentage point in the past 5 years, but we can see they were 30% higher than this at one point. And even in 2024, they were 12% higher. You can see they were lower at some points, but the lowest they've been in the past 5 years is right here. They were 15% and around 14% lower than their price right now. So when I look at the graph, I really like it. When I look at the number of employees, I also really like it. This is a small, tight-knit company, which I really like to see. Their PE ratio is 50. That's very high, but I mean, this company is worth a lot more. $51 billion market cap and a 5.63% dividend yield. So if you're a dividend investor, you know about this company. You know about this company, you own this company, and you believe in this company. So O is a stock that is you know what you're going to get when you buy O. I've owned a lot of O in the past. I actually sold out of it to buy some growth stocks. But now that I've built my portfolio to, a higher value, I'm thinking of getting back in because this is great to diversify your portfolio. Getting some real estate in there, you can't go wrong. And this stock is perfect for someone like you, like me. I have a decent amount of money. I have over $20,000. It's not anything to scoff at. But I don't have enough to buy a property. I don't have enough to buy a rental property that I want to manage, that I want to, that I want to do every single day, do the repairs on. I have to deal with the tenant. So I want to have exposure in the real estate market. I want to have exposure when the interest rate does get cut. And that's my thesis on buying O right now. So I don't support in timing the stock market. I think it's time in the stock market, but I think you can time O with a perfect buy right now. So Realty Income is a perfect buy right now because I'm thinking in September the Fed's going to cut the rate, right? If they don't, it's fine. I'm going to build more O, but it's just how it works. There's rate hike cycles and then there's rate cut cycles. And we just went through a rate hike cycle. The next one is going to be a cut cycle. And that's when real estate starts to boom. That's when, more Realty Income is going to buy heavy. They're going to build their portfolio. Their debt is going to be less because they're refinancing. There's a lot of things that go right for real estate when the rates start to drop. So they also have their investor presentation, which I wanted to look at, because this is a lot of, confidence for investing in this. So this is the 7th largest global REIT. So that's a real estate index. And with properties in 8 countries and approximately 59 billion in gross real estate value. So this is a very big and well-established company. I don't think they're going anywhere anytime soon. Their enterprise value is 80 billion. So they're almost a $100 billion company. And you can see that, they have 342 million square feet of leasable space, almost 1,600 clients. They're in 91 industries, so they're very diversified. So if, single family homes all of a sudden, become a thing of the past, they have commercial real estate, they have, you know what I mean? So this is what I like. I mean, look at their non-retail and then their non-discretionary low price point and or service oriented retail, 73%. I like that. And 91% of their total rent is resilient to economic downturns and or isolated from e-commerce pressures because they're locked into these long leases, these 20, 30-year contracts, that these companies are going to keep paying. And that's what I wanted to point out right here is their diversified portfolio. You can see their partners, featured properties, and clients. Their relationships are the cornerstone of their business. It's a great thing. But that we are proud to partner with industry leaders around the globe like Treasury Wine Estates. Okay, not too sure about that. I've heard about it, but you can see Sainsbury's, 7-Eleven, Lowe's, and Chipotle. And these are just a few of the big companies that aren't going anywhere. I don't think Lowe's is going to, go out of business. You check Lowe's stock, they're probably going to be okay for a while. 7-Eleven isn't going anywhere. Sainsbury's isn't going anywhere. Chipotle isn't going anywhere. Treasury Wine Estates is not going anywhere. And they're locked into these 20, 30-year leases that are guaranteed money for realty income. They have a guaranteed growth path trajectory. Nothing is guaranteed in the stock market, but I think that, this is as close as it gets. So we can see right here that their dividend is also compounding at 4.3% compounding annual growth rate, 658 monthly dividends declared, and 110 consecutive quarterly increases. So they've been increasing their dividend for 30 consecutive years. That's a hard thing to do. That you have to be a pretty good company to increase your dividend, and you see their dividend's already 5.63%. So even if they increase it by 0.1% a year and 40 years while you're investing in this, you're going to be getting a 6% dividend on your stock. That's pretty good. And also another thing I wanted to point out is when you go over to their investor presentation, we see that they have 13.6% compounding annual total return since 1994. The S&P doesn't have that. The S&P's returned 10% on average since 1994. So realty income went through 2008. They went through the crisis, the economic crash of America, and they're fine. They're fine. They have enough money to get through these hard times. They just went through another hard time for real estate, which is going right now, and now it seems like it's kind of overturning a little bit. It's not going to be a bad market to buy all the time. But this is what I love about this company is that, they've taken off, they calmed down. When the interest rate rose, they were like, okay, we need to take a step back. We're not going to keep buying real estate heavy. We already have our, cash flow systems where we're getting this retail, we're getting the retail space, real estate payments. We're in those 20, 30-year leases. We have the multi-family homes, the multi-unit complexes. We have the single-family homes, the single-family complexes. So this is what I really like about this company is the diversity. I think that there's a really good aspect of that. And you can see their 13.6 return and they're consistently increasing dividends. You can't go wrong. And they're positioned for continued growth. So that's the main thing I feel good about in this company is, so when I'm saying buy O, I don't mean, okay, put your whole portfolio in O. I think put 20% of your portfolio in O, 10%, however much you feel is comfortable, but O's going to give you a good return. You know what I mean? Especially buying it right here. And you can dollar cost average down always, but I mean, just you have to buy, you have to have some of this in your portfolio. There's no reason not to. This is just another faucet of income, because you already have the S&P, which is returning 10% a year on average, and then you have O, which is returning 13% a year on average. And then a lot of the times you can see right here, actually, in the past 5 years, we're actually past that, but you see in 2020 they dropped because of Rona. That's to be expected, but then they bounced back very quickly. And I mean, a lot of other stocks didn't do this. So the real estate, stocks move a lot different than the S&P, because look at this chart since, when is this, since 2000? So this is since 2000. Look at that chart, and then we're going to pull up SPY, and then we're going to look at that since 2000, and we're going to see if, the charts are both up, but look at SPY. They've only been around since 2000 as well. So yeah, look at this. They're similar, but SPY is more linear as, going up, but that's because they also don't pay a dividend, so the dividend doesn't show in O's track record, but that 6% dividend is, nothing to look over. That's a very healthy dividend for O, and it just keeps going up. So we could see that this is kind of more of their performance and guidance. There's a lot of numbers to look at here, and we can see, this is what I like to see as well. Their occupancy is over 98%. So almost all of their units are rented, and the ones that are in these long-term leases. And their average dividend yield is around 6%. Their average AFFO per share is 5%. That's a historical total operational return of 11%. Hard to find, outpacing the S&P. And yeah, they're diversified in high quality portfolios. So this is what I really wanted to show right here. Their top 20 clients are 7-Eleven, and this is the percent of the total annualized base rent. So 7-Eleven is 3.4% of their money. 7-Eleven's locked into a 20, 30, 40, 50-year lease with them. The money's guaranteed. It's going to come no matter what happens in the economy. 7-Eleven is not going anywhere. They're going to be here. If 7-Eleven goes out of business, something bigger is wrong. But I mean, we have, look at, there's 7-Eleven is 3.4% of their total annualized base rent. That's a guaranteed 3.4% income from them. Dollar General, Walgreens, Dollar Tree / Family Dollar, EG Group Unlimited, Wynn Resorts, another company that I think is a great investment in the real estate space. Lifetime Fitness, FedEx, Kingfisher, BJ. So I could read all of these, and they're all big brands that you guys know. Walmart is a percentage, Home Depot, LA Fitness, Tractor Supply. There's a lot of big companies that are providing with all of their income in the real estate space. And that's why I feel very good about investing in O, because I have no worries. I know that O is going to go up. I know they're going to go up eventually. They're paying the 6% dividend. I feel very confident. And there's no reason that, at least 5% of your portfolio should be O. There's no reason that it shouldn't. Because I would say maybe you see a better, opportunity somewhere else, but this is just guaranteed. So even if you're investing in those opportunities that are a little risky, like I have some stocks in my portfolio that I'm not going to throw, over, 10% of my portfolio at, but I'm going to hold some of it. Like Honest, I only have 50 shares. It's around $200. Very small position in my portfolio, but I do want to throw more at it. But you see, it's a percent. That the risk that it has is reflected in the percentage of my portfolio. So if someone says buy $100 of this stock, but your portfolio is $200, then, and it's a risky stock, then maybe only buy, $10 of that stock or $20 of that stock. It's all relative to your portfolio and the percentage of your portfolio that it is, not the dollar amount value. So when I say buy I mean make it a certain percentage of your portfolio, whether that's $100,000 or $2, make it a certain percentage of your portfolio. And another thing that O is very good at that I like is you could put this in your Roth IRA, right? So I mean, we could look at the balance sheets here, and I mean this is another thing that just makes me feel amazing about this is, look at this. O has their balance sheet, what they're gonna have on their balance sheet until 2035 because their leases are that long. I mean, this is their debt maturity profile. Just look at it going down and down. And I mean, it's hard to not invest in this company when you see how, they have their stuff together. There's nothing to be, I'm not sure if O's doing this. I'm not sure if O's doing that. There's nothing to feel that way about because O is doing everything right. And then, yeah, it's kind of just their adjusted EBITDA, just stuff like that. I mean, that's pretty much all that I have for their earnings report. But also we can see they have a great amount of clients. They're in a bunch of industries. So let's say, Walmart goes out of business tomorrow, not very likely. They're still in that industry. Everyone in that industry goes out of business. They have 90 other industries. So that's pretty good feeling. So the thing that O has built, Realty Income, that they've built over the past, however long they've been operating for, since I think it was in the 1960s they started their company, they've built a good thing. They've built a good thing that is looking like it's going to be around for the long haul. So I really would get an O right now, and I wouldn't throw, all your money in it, but there's no reason not to put 5 to 10% of your portfolio in it, maybe more. But I think that, with O, I think the returns, they're not capped, but they're guaranteed. You're going to outpace the S&P 500, and you can't do that anywhere else in the stock market. But there's other stocks where you're going to underperform some years and overperform others. But I think O is just one where you're steadily going to slightly outperform the S&P. And that's why you can't go wrong with investing in it. A lot of these stocks I talk about are ones that are going to outperform the S&P by a lot, or they're going to underperform by a lot. These are high moving companies. You know what I mean? They're companies that you're going to get in and make a lot of money, or you're going to lose a lot of money, pretty much. I mean, and a lot of them, you got to just invest in at the right time. I mean, Shopify has been very good to me recently. I haven't bought a lot of it recently, but I mean, you see up over 100% on this one, and that's when I could have lost a lot of money on. I bought it when it was dropping very fast, dropping very quick, and now it's back on the rise. So a lot of these companies are ones that I bought very cheaply, and now they're rising again. But I mean, you can't go wrong with investing in O, like I keep saying. There's no reason not to, and I really do think that O is a stock you need to get in part of your portfolio, and even in your Roth IRA, I'd probably put it in my Roth IRA instead. And the 6% dividend for people that like investing in dividend stocks, it's hard to beat. It's hard to beat. So yeah, that's all I have for today's video. If you guys did enjoy it, be sure to smash the like button. Also subscribe to the channel. It's no cost, it's free, and you get to see all these lovely videos. We're almost at 300 subscribers. We are going to have a giveaway at 500 subscribers, so if you guys do enjoy this, be sure to be a part of that. And yeah, that's all I have for today's video. Buy some O. Just put $5 in it. Just start off the chain. But thank you for watching. I'll catch you in the next one. Peace.